Hey, this is Sasha. Welcome to another episode here on Hungry for Returns, where I answer your trading and investing questions based on my own past successes, failures, and all that good stuff. So today we have a little bit more advanced question about option trading, some earnings, and IV crush. So if you're brand new to options, definitely take a look at some of the courses that we have available regarding option trading on our website at tradersfly.com, and it'll link you to our courses site at rise2learn.com. Now, with that being said, if you have a specific question that you want me to answer about stocks, options, investing, feel free to submit one by voice on that website, and that way you might get featured on the show and you get a more detailed, specific answer. So let's kind of get started. Let's take a listen to the question. It's a little bit more intermediate to advanced question, and I'll see if I can break it down and explain it for you in a little more detail. So here it is. Let's take a listen.
Hey Sasha, hope you're doing really well today. My name's Artem. I'm pretty new to options trading, not even 4 months in, and I have a question regarding option strategies for post-earnings IV crush. I know the Iron Condor is a great strategy, but that limits me into a price range, and a lot of times post-earnings prices may jump significantly up or down. I was wondering if there's sort of an like a long straddle, but inverse, where you could sell the premium. I know that I was playing around on Thinkorswim, and selling a double diagonal or a double calendar does result in a negative vega, but the risk I have is unlimited, and I'm not able to go with that trade. I was wondering if maybe there's something I'm missing, because I want to know if there's a strategy where I could make money if the stock price moves away from the striking price by a great deal, and if the IV of the option goes down as well together. Well, let me know. Thanks so much, and I really hope you keep making videos for a long time. Take care.
Hey, thanks, Artem. So anyways, I'm going to see if I can explain this to you. Okay, so first we're going to try to explain the question, just because I think some people may not understand where we're going with that. And then the second thing is I'll show you some ideas and things to think about. Ultimately, remember, when you're trading earnings, it's a guessing game. Even if earnings are great, stocks may sell off. Even if earnings are, bad, stocks may pop higher due to future expectations, whatever the case is. So understand it's a guessing game with earnings, and that's why a lot of traders, at least traders that are trading with big money, and a lot of it, they're trading indexes like the S&P, SPX, when it comes to options, or the Russell, those kinds of things. So anyways, with that being said, let's take a look here. What was being said. So typically after earnings, there's an IV crush, as Artem said. Crush meaning it compresses, right? There's volatility, and then earnings comes out, it gets crushed. So when we look at these kinds of things, he was looking at a long straddle. So here's our long straddle. Okay, so you get one of these before earnings, right? And then all of a sudden, boom, either stock goes down or stock goes up and you make money one way or the other. The downside is you pay a lot on your theta, because you're losing big time, because you're buying each options right at the money, which are the juiciest. And then, but you got to also positive vega. So he's thinking, well, what about something inverse? Well, how about we do something like this? This is what he was looking at. So now you got positive theta. So you can wait for a couple days until the earnings comes out. And then once earnings explode, well, ideally you'd want to be making money, but in this case you got that unlimited risk, he was saying. So is there something alternative? What he was then looking at, okay, well, how about, here's our Iron Condor. So here I have an Iron Condor set up. I'm just using Tesla as an example. So in this case, this is what he wants. He wants that theta, okay, but or in addition, you got that negative vega, but the difference and the problem is you're confined. That's the problem. Whereas the other ones, with the straddles and strangles, you're a lot less confined than you are here with this Iron Condor. You're confined, and it becomes a problem. So I will tell you, there's no gimmies in the markets. There's always trade-offs. Hey, if you want to shoot video in low light, if you don't have light, you're going to get a grainy picture, or you have to get a way better camera, that kind of stuff. So there's always trade-offs, and the same thing here. There are some advanced strategies to kind of tweak things. You being 4 months in to ask these kinds of questions, I'd say that's quite advanced and a very good job. I think what you need to take a look at is the typical approach. Remember, with earnings, you don't know if it's up or down. What you would do is you would take these two strikes right here and you bring them in, and then you would have a kind of a calendar, which makes, not a calendar, but a butterfly. And this would go ahead and create a trade that's a little bit more like this. Now, you could do this butterfly with this iron butterfly, which means you're splitting the calls and puts. Doesn't matter. Or I could do a butterfly where it's all calls or all puts. So with a butterfly, taking a guess to the upside, taking a guess to the downside with puts, all works out. And you know, you're spending about $276 to take a chance on these. And you know, when you do that, that chance is basically, hey, you might lose a lot of your premium, you might make a lot of money, but you don't really know. But this is, even though here it says a positive vega, you can't let that throw you off, because remember, when it comes to that butterfly, it's really, once you start moving into this direction right here, you're going to be negative vega, and that's really what you're trying to capitalize on, right? So that's the name of the game, if that's what you're looking for. Now, for some people, you could put it right at the money. Okay, so I don't have an example like that, but let me make one real quick. So you could go ahead and say, hey, I'll put one right at the money, and that'll be around 230 right now. And let's just go to a 250 and a 210, just to get numbers even. So you could put one in the money, but of course, just like with the iron condor, you know, you're in this range, and yeah, it creates a little bit of a problem. So in some cases, what people do is they create kind of a double butterfly, and now all of a sudden, as time ticks forward, well, even if the stock price doesn't move much, well, we don't lose a lot. It costs you a little more to put this on, right? Because if you do a single one, it costs you about $350. If you do a single on the other one, $276, and to do both, you're about $600. But your loss is probably about maybe half of the other one. And sometimes it's not even worth it, because you know, you're trading more contracts, so commissions could be a little bit of a problem. But if it goes down or up quite a bit, you're still capitalizing on it. That's the normal and healthy way, I would say, to trade earnings as far as a single strategy goes. I wouldn't get into anything too much more crazy than that, because what's happening now is you kind of want, you know, you want to sell premium, but you also want, you know, unlimited movements, and it's almost trying to get too much for what you're trying to do. Instead, I would maybe tweak a strategy and make it much more simple, like, you know, even a single butterfly, pick a direction one way or the other. You could even do it with a vertical if you really wanted. But you know, look at it like that, rather than, you know, trying to cram in here, you know, with this, here is our, let me go to today. Here is our straddle, okay? Trying to make as much as possible on the move, versus, you know, something like this. So trying to still make the theta. So you got to pick your battles. If you want theta or you want movement, okay? You always got to pay for it. Nothing is really free. In martial arts, there was a rule that we always went by. You know, everybody works, nothing is free, and everybody starts at the bottom. So we can't really have everything in the marketplace and have it give me, so there's always trade-offs. So if you're trying to get something like an unlimited movement, but without paying too much, to get it in both directions is tough. I will show you one strategy right now where you can kind of do it in a single direction, and you could be more creative. You could be able to maybe do it in both directions, but again, be aware there's some serious risks associated with it. And why is that? Well, because what we're going to do is a back ratio spread. I'm not a huge fan of them, you know, but I'll show you how it works, and the profit picture for it. So what you're really doing is, okay, well, I want unlimited profit, right? I want unlimited movement to the upside, right? So let's say I'm betting that this stock is going to head higher. Well, if this works out, what I'm doing is I'm selling one, and you're selling one kind of in the money, or it may be in the money after earnings. and I could do one a little bit even tighter, 240. I could do a 230. So you could see, even if it sells off in a big way or doesn't move, you know, I might be able to make some money on it, right? Because I'm selling a 230 and buying two 250s. So what does that mean? I'm selling a 230. I'm selling this one and buying a little further out. It'd be two 250s over there. So let's say here, 22 strikes. So I'm doing one of these and a 230. So I'm selling one of those and buying two of those. So when I sell these, it offsets the cost of that because it's kind of at the money. And, you know, the downside with this is, of course, if this pulls back and it stays under that 235, well, I sold one. That means I could be liable for the stock price at that price. Now, if it explodes, you know, well, it works out in your favor. And you also have kind of a sea of death problem here, which is, you know, about $1,100. So this is another way to play a directional move. Again, it's not, when you look at this move, you know, it's still not negative Vega. It's still positive Vega, but you got price movement. Now, could you combine two of these? Yeah, you kind of can. Let's just show you kind of an example here on the put side. Let's say I'm doing the puts, but again, there's some serious risks associated with that, right? So if I go now with two of those and buying one of those, and here, let me reset it here. Here, buy back ratio. There we go. And now we'll go with maybe a 205s, and I got a 210 here, make it live price. So you can see you know, paying a little bit. And remember, the more you move this around, the profit picture starts to change. So if I don't want to risk a lot or pay pretty much nothing if the stock doesn't move, well, in this case, you know, that means for me to actually make a profit, it has to really tank. Whereas if I, you know, actually willing to risk a little bit, then it doesn't have to move as much. So anyway, if I do two of these together, one September 6th, one September 20th, there we go. You could kind of get something like this, call it like Batman. So you could kind of get something like this without paying too much. And you can see if it really doesn't move, then you're not really paying too much. But you got this, they call it the sea of death. Right here, these two little problems, it's like bat wings, where it is a problem. So, and of course, you're going to be in the money on one of these, and that, of course, is a huge issue where a lot of traders don't like to be in the money. So be aware that this one has some serious risks, but anyway, that could be something you look at or investigate. I normally would recommend keep things simple. You know, a simple butterfly one way or the other for earnings, you're risking maybe $300 to potentially make, you know, double your money. And that's a nice movement, right? So if you actually, you know, let's say you go a few days into it and then you had the implied volatility that went with it, you know, you're risking about 300 to maybe make about 300, and it's to double up your money. That's some pretty good serious return on investment. So anyways, I hope this was helpful just to get you thinking about some things. I know we've covered some more intermediate to advanced things. I usually don't like to get too crazy or too complicated on the trades because I find once you start putting a lot of them on, let's say you're doing 10 earnings trades, it becomes harder to manage. Like, how do you do the adjustment, the fix, what's your plan? It just becomes more convoluted and blurry. Instead, I'd rather keep it simple. But again, it's up to you. My goal is just to kind of teach you a little bit, and then you can make it your own, right? So camera in one person's hand will take a different picture than a camera in another person's hand. Everybody sees things a little bit different. So there's some things for you to take away and walk away with, and you can now make it your own. So I hope that was helpful. So anyways, thank you so much for joining me. I hope this video was insightful for you. Be sure to check out our, you know, books, courses, membership things, all good stuff. Helps support me. It helps support the people that edit these videos, put up these videos. So all the employees that go along and help make these videos possible, because we couldn't do it without them. So thank you so much. Be sure to subscribe and of course get on the newsletter list so you get notified as new cool videos are released. promos, discounts, coupon codes, all that good stuff, along with good new releases, which we have coming up soon. Mindsets of a Master Stock Trader book coming soon to you. All right, thanks for joining me, and see you next time.